a couple of years ago, where through Brexit, we said that's going to introduce some real risks. So as the economy kind of cuts off the relationships with trade, with finance and so forth, and reduces the number of people that are coming into the country, all of those things make any individual country more susceptible to shocks. So when a shock happens, as Goldman Sachs, when they look at the UK, they say, this is going to hurt. And it is. Inflation looks bad, growth is contracting, so that they'll probably be at -1% or so this year. The rest of the Eurozone will also be probably underwater, will be negative because of the food shocks and the energy shocks that are impacting Europe. The US will be probably kind of in the middle of the pack. So having come down from, say, 5.5% to now in this past year, 1.9, we're probably going to be flat-ish in 2023. Whether that is a negative number, negative 0.5%, whether it's positive 0.25%, don't really know whether it's going to be, it'll be a formal recession or not, but just think flattish growth for the US. Where that is coming from, it is the big detractor we've already started talking about. Harry was talking about this, is in investment. So not only residential, but commercial investment as well. Those numbers are going to be actually negative. The other big parts of GDP, which we all know from our economics courses, consumption, there's investment, there's net exports, and then also government spending. The biggest part of that is consumption. And when you look at what's gone on with consumption, the adjustment down, the slowing, has been dramatic. So the move back to what should be kind of normal level of spending for 2.5% kind of growth, think steady state for the United States, we're probably just past 75% or so of the adjustment down. So consumption is still growing, but it's growing at a slower pace. Now, all of this, when you look at what's happening then, so we think with this flattish growth, the risks are definitely higher in investing. So as we look out across the world, we see higher risk both from the financial side, because savings have gone down and debt has gone up, both private and public. And that's what central banks were trying to do. They were trying to make it cheap so that people would borrow. And they did. And so debt levels went up, especially with risky firms. And so the environment from a financial perspective, savings down, debt up, is more risky. From an economic perspective, globalization has been backing up. And so just think of the case that the UK that we just talked about. We see more and more countries going in that direction where they're backing away from globalization. And when that happens, shocks can get more amplified. And so we've got risk higher from an economic perspective. And then finally, from the last thing, from a geopolitical perspective, we've seen just think Russia, just think North Korea, Iran, China, etc. So things are getting riskier. And what that is saying from an investment perspective to us is that we're in this environment where you no longer get the boost from falling discount rates, right? When those discount rates have been going down for years with interest rates, you can get bailed out in investment decisions just because the whole market goes up, right? That's not going to happen anymore. And so you don't get bailed out by risk-on trades from central bank. And so what it means is that fixed income rates are higher, and so bonds are going to become a much more important part of the investment portfolio over time. And so people are going to be shifting out of equities. We'll hear more from Brian, I'm sure. But then the second thing is you don't get bailed out from risk on anymore. And so your individual security selection, and then with this group, underwriting that you do, has to be much more refined because there's no easy way out.
Gene, let me just follow up on one thing. With your forecast for flattish growth in the American economy, is that enough? Is flattish growth enough to bring down inflation to that Fed 2% target rate?
Well, I think the answer is possibly. And again, like Tom was saying, we all have to watch and see. We have contraction in some areas of the economy. So we already are in recession from the investment side. So you talk to any of our friends that are in the real estate business, that's residential has been already going down. You look at what's happening in other interest-sensitive parts of the economy, financial services or other parts, you look at the technology side, yeah, things have already started moving down. And so, but there are other parts that will stay more robust, and I know as Laura was saying, the employment markets actually overall look pretty good. And so what we've got though is, job openings have been moving down quite substantially, and we're starting to see layoffs. But it won't necessarily take, say, moving down to a -1% growth or -2% growth in order for the heat to come off of inflation. As long as we've got softening in demand, and we've definitely got that. We've got a labor market which is cooling. We definitely got that. And then when you look at the rest of the supply side shock, if you look at order backlogs, time of delivery, all of those things, the supply chain is coming back. It's not done, but it's like 75% of the way back. If all of those things continue to go in an orderly fashion, we won't necessarily need -2% growth to get inflation down.
That's a very important perspective. Brian, let's turn to you. Your team in the Chief Investment Office at Bank of America. What are the signals you're seeing? What are you seeing right now? What do those signs tell you? And what's your view forward looking for the year?
Yeah, so thanks for having me here. If I was here last year, I didn't have a single gray hair on my head at this time last year. So I just want to set the table that we're coming off one of the most difficult investment environments, I would say going back to late 90s when we think of some of the emerging market currency crisis, long-term capital management, where we had multiple macro issues to wrestle with and deal with. It's been a long time since we had that. The global financial crisis, all of us in this room know, is a real pinpoint, hard-hitting issue. But now we have an inflation issue, right? So Tom was talking about, Laura talks about it. From the Fed, they're obviously worried morning, noon, and night about inflation. So we don't think that we're going to have that great of a year in markets and in the economy, given where inflation is and given where monetary policy is. It's just going to be very, very difficult with rising rates, which affects all industries' cost of capital, frankly, right, across the board, but especially the interest rate sensitive ones like Eugene mentioned, number one. Number two, we also have quantitative tightening going on, which is pulling more liquidity out of the system. I think it's going to be very difficult to get good growth, good GDP growth, good economic growth, like Eugene was saying. It's going to be flattish to maybe a little bit negative, but that's really what the Fed wants, right? That's what's going to stomp out inflation. Now, Laura can tell me if I'm wrong on that, but I think that's where we need to go, and the good news is we're seeing it. Think of gasoline prices, crude oil prices, natural gas, corn, wheat, rents. I've seen rents finally cracking up in New York, right? Residential real estate. We see all these things moving over, rolling over. M2 chart, right? No one's probably pulled, Tom had a great comment, no one's probably pulled up an M2 chart in decades, right? Take a look at the M2 chart. You'd be really surprised. And it's actually rolling over now. So their policies are working really well in our view, but it's going to slow everything down from the economic standpoint, and that's going to be reflected in markets. So we think we're going to have a first half where the data is going to continue to get worse. Harry was talking about some of those data points, how it's a lagged effect. That's really important, right? It's going to continue to get worse before it gets better on the data front, and markets are going to be very nervous about that. Eugene hit on this, right? Look at the volatility indexes across not just equities. We've looked at equities for the past decade only, the VIX index, but interest rate volatility, interest rate VIX equivalent, and the currency volatility indexes are all spiking up too this year, over the past year in 2022. So it's a really tough market to navigate, the toughest one, again, going back to the late 90s. It's probably going to be weaker data first, but then we're going to set the base for the next cycle. And why do I say that? Because the consumer is pretty healthy, right? Compared to other recessions that we've led up to, the consumer is in much worse shape. We're in pretty good shape right now. They're working down some of the excesses that they built up in their savings and checking accounts during the pandemic, and now they're working through that, but they're not all the way gone. So that's a little bit of a ballast there, right? So that's a positive. Corporates, I would argue the balance sheets are stronger there as well after a decade of generating very strong free cash flows, being a little bit more prudent, the global financial crisis scaring the devil out of everybody, right? So you see that development on the balance sheet side, corporate-wise, that's also a little bit of a stronger maybe platform than we've seen in previous recessions. So in the back half of this year, you might see the equity market start to get a little bit of a lift if we continue to see the inflationary pressures and data come down and meet the Fed's objectives on what they're trying to do. So it's working is the good news, but the data is probably going to be worse in the short term is the quick answer.
Laura, I want to come back to you because I think a key issue for so many people in this room right now as they contemplate their business plans for the year ahead is what will happen with rates. You are at the Fed. You know what's happening at the Fed. You know the thinking in the Fed. Tom, obviously, and I'm sure you are in a parallel way of thinking, you can't forecast what the Fed will do. We can't forecast what the Fed will do. But I think what could be helpful for us is understanding what signals you are going to be looking at and we should all be looking at in terms of where rates will go. Are there certain data points that will be coming in that can help us foreshadow what the Fed will be doing over the course of the next year with rates?
Yeah, absolutely. So I've been with the Fed for 4 years. Before that, I was an academic economist, and I taught a class called Money and Banking for 17 years. And I'll be honest, when I joined the Fed, I thought, what am I going to think when I'm inside, right? I've been teaching about independence and, you know, how the Fed operates, but from a textbook, right? The thing I always tell people about my view now at being inside the Fed is that all of this, none of it is an exact science, right? And especially given how unique this period of time is, and that it's been 40 years since we've seen inflation like this, and a lot has changed in 40 years, to your point. It's very hard to know exactly what's going to happen. There's no crystal ball. I wish I had one. However, I will say that what I have been very impressed with about the Bank of Richmond, each of the 12 banks are independent nonprofits. So we all operate a little differently. My job doesn't exist at some of the banks. But the thing that I've been impressed about our bank is the way we prepare, Tom, for these discussions. We're not just relying on data that has these 12-month lags. We're not just looking at the kind of normal tea leaves or data that people would expect. We are out all day, every day, a large team of us talking to people about what they're actually experiencing. And I think, to Harry's point, one of the things that has been pretty shocking is that as we talk to businesses, and Tom mentioned this in his comments, they are anticipating needing to turn the page and maybe reduce employment, or that demand is gonna decline, but many of the people we talk to have not done that yet. They're not seeing a reduction in demand. They are not letting people go. Tom mentioned a lot of them fought very hard for the workforce they have, and so some of them are saying, we're going to be more hesitant to do that now than we would have been 10 years ago. So I think the employment picture is really important right now. We still, job postings have come down considerably, but they're still way above where they were pre-COVID. And if you've read Jay Powell's comments and some of the press releases he's had, press conferences he's talked about there being a better balance between supply and demand in the labor market. I think they're looking really closely at that based on what I've read publicly. And then obviously the data on, the hard data on inflation, but also what we're hearing from people as we talk to them in real time about what they are doing with wages, what are companies doing with pricing as they move into 2023 and beyond. That all plays a really significant role. So I can't give you an exact answer, but I will say now that I'm internal with the Fed, I have a lot of confidence in the process. I have a lot of confidence in the people that are sitting at the FOMC table, and I have a lot of confidence in the way we prepare Tom to go to those meetings.
Well, and that's fascinating to hear, for you to pull back the curtain for us to help us understand how the committee really works, that it's your real-time intelligence from conversations in places like North Carolina, reporting back to Tom, who reports back to Jay Powell and the committee, and that's how they formulate decisions. That's fascinating.
It's part
to hear
of
about
it,
that.
right? Yeah, it's part of it. And probably, you know, Tom was CFO of McKinsey. He has a business consulting background, and so Tom really loves that real-time data and interacting with businesses just as much as he does the more traditional economic research. So every bank's going to be slightly different, but it's a huge part of the process. We spend a lot of time on it.
And I'm also struck by your idea that in talking to people across North Carolina and in this area as well, this reluctance to lay people off, this idea that we want to retain our workers right now, that I think for anyone, whatever your business here is in our part of the state, that bodes well for your business in the year ahead, I would think.
Absolutely.
So, Steve, I think this is, you know, understanding this perspective that Laura and Tom are bringing is really critical, because it's underlying what's driving the it's part of what's underlying driving the markets. As market participants and global investors, we're trying to understand that part, but we're looking across the economy to try to understand, okay, so this is part of what's going on, but what are the other things that we have to look at in order to get our market forecast right? And so as we think about what's going on with inflation, you know, we're looking globally and we're saying, well, so what has just happened? We've moved from this spike globally up to about 8%. And then we've moved down then to where we think we'll come in. It's something like, you know, it's been about 5.5% last year, and we think we go down another 2% or so globally this next year. So think kind of chunks down in inflation, 2.5% to 2.5% globally. Where the U.S. is with respect to that is we're moving somewhat faster, because Laura and Tom, as they said, we've seen this playbook before, we're going to be aggressive. And so they're pushing it down faster in the US than in the rest of the world. So we think that we come down here in the US to something like, you know, we moved down from 5.5%, we started at the same place as the world, so we were right at the mean, 8% inflation. Coming back down, though, much more sharply, so maybe into the area of even 3.5% this coming year, and then down to about 2.25% in 2024. And all of those things, that forecast is predicated on three things, which is how demand slows down, and again, we're seeing slowdown in goods and services demand, where it's not going negative, but it's just the growth rate is slowing. That's number one. That's the demand side that pulls on inflation. And then the push side comes from supply. And what's going on from the supply perspective is labor markets are softening on the margin a little bit here, and they're likely to get worse, as Brian was saying. But then we're also looking at what's happening with supply overall with goods. And so that we're asking what's happening in the supply chain. And as we look at the supply chain globally, and then in particular in the US, again, what we've seen is something like 75% healing that's happened, but we're still in a worse place than we were before COVID. And so we've got to see those things subside. If all of those things play together, then we can get this kind of story that I just described, where we can get inflation down to 3.5% or so, and then 2.25% in 2024.
Supply chain healing is the key, and it's great to hear your encouraging view of that. I know many of you have submitted questions through the QR code on your table, through the app, and Peter, let's get some of those questions from people in the room today.
Okay, Steve, thank you very much. First question, how much do you think government spending is contributing to inflation?
Let's take a look at that. Harry, your view of that, government spending and the impact on inflation.
Well, I think it has a great deal to do with it in 2020, of course, and in 2021, with the helicopter money when we were giving out trillions of dollars, the Fed's balance sheet grew. When it grows, the balance sheets of banks grow automatically. They go tandem. They go hand in hand. And so we were increasing. Actually, I did look at the money supply, M2, and it increased about 18% in the second half of 2020 and 2021. At that rate, you're going to get inflation, and sure enough, we did at the end of the year. So we were trying to accommodate all of the money that the government had thrown out to people in the economy. And so I definitely think that that's part of the inflation problem, was the amount of money that was put out, and then the Fed had to accommodate that by creating the money. So they went hand in hand.
Another question, Peter.
Okay. Can we expect success in containing wage inflation by raising interest rates? There seems to be a disconnect.
And that's one of Laura's specialties.
Yeah, interestingly, and Tom mentioned the wage data being seen as a real positive today. And I'm just as eager to see, every month I'm just as eager to see this as people that don't work at the Fed, because we don't know exactly what it's going to look like. We are hearing, with the people we talk to, the roundtables that we hold from our boards, we are hearing about pretty significant pullbacks in wage increases. I made the point before about how companies are saying, hey, we fought so hard to get this group of folks, we don't want to let them go, but we are also hearing them say, hey, we've given this group of folks, we have significant increases in wages, and we feel like now is the time to kind of pause that. So the data, the hard data on it, and the kind of anecdotal data we're hearing on wages is positive, I would say.
Yeah, and you got to look at where it's going to hit, right? And so the way the process works, right, Peter, is that the Fed raises these interest rates, and then the interest-sensitive parts of the economy are the ones that get hit the first. And so real estate and investment, those places have already gotten hit, and they're getting hit more. And so layoffs are starting are definitely happening there. Other financial services and parts of the economy are obviously slowing down. And what that does is it reduces aggregate demand. And as aggregate demand comes down across the entire economy, then everybody backs up. And that's the process. That's kind of the theory of how it would work. And you look at the data, and that's what's happening.
Let me say, too, very, very good point. And I'll also add that one of the, and this fits all together what we're talking about, people did have excess savings in general moving into this. As an economy in whole, a tremendous amount of excess savings. And inflation is a tremendous tax on households, right? And that's especially true for lower income households. Lower income families did get significant amount of stimulus in 2020 and 2021. And so many of those families, those consumers, were actually in a better place financially than they would have been pre-COVID, and that has helped a bit. Now, if you look at the bottom quintile of income earners, those families have used up their savings and are now in a pretty rough place. So, Tom mentioned, if you're serving lower income customers in your business, or you yourself are a low income family, you feel like you're in a pretty tough recession right now, most likely, because you have used up your excess savings, and the things that people do care about, like rent and food and gas, have been up.
Could that, though, bring more people into the labor force?
It
that
could.
vexing question.
It could. I think there's signs out there that for a lot of the people that are not in the labor force is because of non-wage barriers. If any of you in here aren't paying child care currently, which I'm not any longer, thank goodness I graduated from that, although now I'm paying for college, which could have a different conversation about that. But ask somebody at your table what they pay for child care right now. It will blow your mind. So there are these non-wage, which is related to income, right? You got to have enough income to pay for childcare, but it's not just about the wage the company's willing to pay you. It's these other things. And so I think wages are an important part of the conversation, but I think there's also clear signs out there that we need to broaden the conversation.
Well, and a key part of that, does it pay to go to work when you have to pay so much for childcare?
Right.
Brian, you have a thought on this.
Yeah, I was going to say, along my theme of the toughest environment we've had to navigate in a really long time, It's also going to depend by region. You guys experience this here, right? Markets like North Carolina, South Carolina, Florida, Texas, they're going to have more wage pressure because of the demand and the above average growth we're seeing economically in those regions compared to maybe Northeast on the East Coast or the Pacific Northwest where things are slowing down quicker. So that makes it really tough for the Fed, for investors, for economists to navigate because of those reasons as well. And I think this time you might see something where, because there is this tightness in the labor market, maybe we don't see as many layoffs as we had in past cycles. People are going to hold on to their employers, but maybe they work less hours. Maybe they're paying a little bit less on that wage or bonus, or there's different tools that companies can use to take off that labor pressure or that labor cost pressure.
We'll go to one final question, and then I'm going to turn to each of you for some final thoughts on the day. So, Peter, one final question.
One final question. Okay, what are actionable recommendations or considerations you have in mind for the audience to mitigate risk and recessionary headwinds?
Gene, let's go to you. Risk is your specialty. How do we mitigate the risks of these inflationary headwinds we're seeing?
Well, there's a lot of the risks that are popping up now. Some of them have to do with the financial and economic environment, as we discussed. Other parts are things like political risk, the geopolitical risks, which can change things a lot. There's regulatory risks, which are moving quickly, and then so we have risks that are popping up on all kinds of fronts, cyber risk, et cetera. What all companies are finding, and what the companies that I work with, is if you look at the size of the line, so the investors, the salespeople, the client-facing people, relative to the rest of the firm, so compliance, legal, human resources, et cetera. What you see is we are just raising this side of the people that are dealing with regulatory risk, that are dealing with cyber risk, that are dealing with human resource issues where we're trying to search out in hire and then retain the right people, so people that are focused on human capital development. That side of our businesses are going up really quickly compared to the line. And I think that's the only way that we're going to be able to deal with it, is we have to keep building the sides of our businesses that are human resources, information, technology groups, regulatory, legal, et cetera, to keep up with this quickly changing environment. Otherwise, there's chances that you get blown up and you don't get a chance to play tomorrow. I mean, we don't like it that these costs are going up, but the risk is if you get blown up and the regulators come in and shut you down, or your clients walk away, then you're not here to play tomorrow. And so it's really not a choice. You've got to make sure that risk side of your firm is robust.
Risk assessment and action to prevent, to mitigate risk is key. All right, we're running up against our ending time here. I'd like 30 seconds from each of you, based on what we've talked about here over the past 45 minutes. Where are we going in the year ahead? What are you feeling about where we're headed? Brian.
All right, so let's go tie into the other question as well. We have fixed income attractive again. Been a decade since you could say that, where bonds are more attractive than stocks. We've been overweight equities for so many years in a row. That has pivoted. This is a big regime change. You can get short-term income, good short-term yield, more secure going into a recessionary slowdown environment. Equities are more fairly valued. Quick fact for you, we started this time last year at 21.5 times on the S&P 500 PE multiple. It went all the way down to 15, maybe 14.8. Now we're back around 16, 17 times, depending on the day. So equities are fairly valued. Bonds are still a little bit more attractive. Add some bonds to your portfolio where you can get some good yield for the first time in a really long time.
Harry, your final thoughts.
Okay. Well, in the post-World War II period, we've had 12 recessions. The average length, about 10 months. We're going to have a recession. It's going to come up, show up at the end of this year or the beginning of 24 of the next year. But it's going to be shallow. It's going to be short. We're getting a fiscal stimulus this month. Social Security payments are going up 8.7% this month. So the economy looks pretty good. We're going to continue to give it stimulus, again, in the Social Security payments. So there's no reason that we would have a deep recession. We haven't had really two in the last 50 years that were all that severe. The 2008, of course, and one in the 1970s. So North Carolina, amazingly, if you think back to the last recession, North Carolina is an incredible state, to some of Chris's points. We got through that pretty easily, quite frankly, as a state, because we are such a fast-growing state in terms of population. So we can expect to continue to do that.
Laura.
Yeah, mine are going to be similar. I've been saying a lot that historical context matters. And it matters that most of the recessions we've had have not been very severe. It also matters that for everybody in the room that's 40 and under, the two you remember, which are COVID and the Great Recession, were really severe. And a lot of people now that are making decisions as households and as business owners, that's all they've experienced. You've never seen interest rates this high. You don't know what a CD is because there's no point in putting your money in one. You know, you've never seen a mortgage interest rate above 5%. So historical context does matter, and right now I understand a lot of the concern because of that, because people haven't seen a situation like this. I vacillate between feeling more negative and more positive depending on what data have come out, and right now I'm in a more positive place. I think that 2023, I don't expect, to Gene's point, I expect growth to be relatively flat, but I also think that North Carolina is quite insulated from a lot of the downturn we may see.
Gene, your final thoughts.
Yeah, so with my investor hat on, we've got this slow growth environment, no more getting bailed out by the risk on central bank trades. And so you're going to have to really focus on security selection and underwriting. With rates rising, bonds are becoming more attractive, and so the bond parts of the portfolio are going to get rebuilt and reestablished. And then with my management and governance hat on, make sure that the risk side, the operations side, regulatory side, legal side, human resources, that part of the firm gets built up enough, because we are all going to have to make money the old-fashioned way. I mean, it's going to be in the trenches and working company by company, and no more risk on.
Thank you all for a really important and enlightening conversation, a conversation that I think can help guide our thinking as we're planning our year ahead. I appreciate all of you once again this year, and again, glad we could do it in person. Thanks all of you for joining us. I know Mary has some final thoughts for the day.
Thank you all. And thank you. We really do appreciate your insights. It puts it in a new perspective. We greatly appreciate that. Thank you all for attending the 21st Annual Economic Forum again this year. We look forward to seeing you every year, and we look forward to seeing you next year. Be safe and have a good day.